Hello and welcome. My name is Kris Alary. I'm an advisor with Bowie Financial. I wanted to put this video together today to simply talk about some of the things going on in the market. I think it's no secret that there are developments going on around the world that are having impacts on our day-to-day lives. And so I wanted to have an expert come in from RBC to talk about some of the things that they're doing right now to be helping protect our clients, as well as talk about some of the things that are coming in the future to help us all be better prepared. So of course, I do want to welcome any follow-up questions or discussions you'd like to have after this video. I am here to help and am easily available either by phone or by email. So with all that said, I'd like to introduce a senior consultant from RBC, someone who's been around for a long time and who's been a terrific resource for us here at Bowie Financial, someone that we lean on for help, advice, and expertise. Real Ethier, thank you and welcome.
Thank you, Kris. Very happy to be over here today.
Terrific. So with all the pleasantries out of the way, I'd like to jump right into it. And why don't you tell us what's going on in the markets right now?
That's an amazing question. There's a lot happening in the market these days, and I'm pretty sure that people are watching the news and watching their portfolio returns and whatnot. So it's I think it's a good, timely conversation that we have today. And if anybody has questions, we'll be happy to take subsequent questions through you and your viewers after that. Well, what's been happening right now, as you probably noticed, this war that's going on with Russia and Ukraine. Unfortunately, abstract of all the horrible things that are happening, we have to take a stance out of this as a non-emotional way and view it as an economic kind of way. So what I tell you right now doesn't remove the fact that it's a bad thing that's happening. It doesn't alleviate it. However, we'll be reviewing how it affects your portfolio itself, and if it can be, is it something to worry about, or is it something that's going to wash over a bit, I could say, so we can look forward to better days. So the first thing that's happening, before the war, let's have a look at the fact that there were rising rates. So we went officially, we're no longer in a decreasing prime rate, let's say, economy. We've been in that phase for quite a while, and it was fun to see on your variable rate mortgage to go down, but now it's going to be the other way around. So this is putting a bit of the strain on the market. We do expect about 4 more increases between this year and the first part of next year. So it's not too bad. It's still something that points out to being fairly solid as an economy in Canada and in the US, as we saw, I believe, very recently or yesterday, we saw an increase by the Fed as well, following 25 basis points up, which means they believe the economy will still go on a bit strong. But we can probably review this a bit later on in the conversation. The other part that's been impacting the economy is the Russian war. Now, we saw the invasion of Ukraine, which was basically something that was a bit forecast and unfortunately seen up to 2014 when they started back then. It did impact the portfolio. I took the liberty of pulling up a bit of statistics for you viewers, Kris, so if you allow me a few seconds, I'll pull it up and I can explain what's happening and why you're seeing some movements in there. So just allow me a few seconds.
Please.
And it should be appearing in a few seconds. It should be right there now. All right. So what you're noticing right here, and if it's probably showing at this point, can you see what well, Kris?
I can see well. I hope our viewers can as well. But I can see the chart as very well. Yes.
Yeah, I'm going to zoom it here. There we go, just in case, because I know sometimes it's a bit small. So this should be a bit more let's say, it's going to fill the screen. So what we're seeing here is the result of past wars. So what we're seeing right now is the direct impact of the portfolio, saying when you watch the news, your online portfolios, you saw it go down for sure. It already had started to go down a bit at the start of January because of the, the fear of the crisis that could happen, the fear of rising oil and energy product, the fear of probably rising rates. There's a lot of reasons to fear in the market. Omicron that's still there, we should still call it COVID, I guess. But it's a lot of things that are still okay. It's vanishing away. But what took a lot of the heat was the war. So in the graphic you're seeing here, and we can share it if ever somebody wants to have this, we'll share it with Bowie's team. It just shows that the average of impact on the portfolio is about 5 to 11 business days. So the negative impact, if you see the upper, let's say the upper echelon right here, it says that's a decline. So the number of days that there's an impact, the average drop in the market is about an average of 2.7%, and the number of days it takes to recover. So that this is an average for all the wars that we've had in a long time. So it goes way back. The two worst parts that we had were probably, I would say, Iraq, which took about 138 days to recover, and we lost 18 points. 18% in the market. And you also had the Pearl Harbor, which took 240 days, and it chopped off 8% of the market itself in your portfolios. So we're nowhere close to those type of events. This is more localized toward Europe. So definitely we think that it's going to be something that will recover. It's something that is not, it's not a good thing, but it does create buying opportunities for a manager as well. It creates a momentum where markets go down, and if we have sufficient cash reserve, we can make strategic purchases. So not to remove the emotional thing, the market is like, I like to say, it's like a goldfish. It's got the memory of a goldfish. It will take a quick notice of something, and then it's going to go up. You know what? There's something else happening. It's going to go to the next best thing. So 5 to 11 days, and we've already started to see some, refluctuations. We saw that oil and the energy sector is doing a bit better from the high peaks that we lived 2 weeks ago. So this is getting better as well, and we're starting to see some stability because of the war. It's going to stabilize a bit. Don't forget, though, that if China does get involved, it might prolong a bit this, but it's not a time to panic. It's actually a time to purchase should we do something like that. So that's for the graph.
Absolutely, and very well said. I know I mentioned that you had been around for a long time, but also RBC has been around for a very long time, right? And although every crisis or every volatility period has its own unique patterns, but you can relate back to previous times of market volatility. So can you just quickly kind of go through RBC's historical track record when it comes to dealing in times of volatility and how they've performed?
Sure. Yeah. I mean, that's a very good concept. I will share you another screen, just one more second, and we'll go through the metrics of that. And that's the visual aspect. Then we can go on to a bit more the theory of what's going to happen and things. So here we go. We should be able to see it right away. And that my laser pointer right there. I do apologize. There could be some French word that you notice in there. There's some franglais, like we like to say. I received the notices from the Montreal office, so it's a bit of I didn't get a chance to translate the whole thing, but numbers are numbers. I'll be able to explain it very quickly for you guys. Now, it looks like a nice chart. It looks like a usual investment, but bear in mind, this is for all the investments at RBC. You're going up and down. These are the number of quartiles. So, and the quartiles is like when you're in a marathon. You always want to be first and second. You don't want to be like in the third and fourth quarter because you're lagging behind. It's difficult to go ahead and all this. And in the investment world, what you see is you're always first and second. Well, the first 50%, you tend to have better rate of returns, or you will better protect in the downside. Now, the last couple of years that we've lived, exclusion of COVID, we've had amazing years. I'm pretty sure everybody was happy with the portfolio rally they had. It's been very strong, especially if you had some US. You did some very nice returns out of that. COVID took a bit of a hit because it's a sanitary crisis. It's a bit different. Took a bit longer to recover. 2 months, 2 or 3 months. Like it was still fairly quick. It's not like a war, but this is a trend from RBC's all fund categories. So I just want to show you the trend here. From 2014, if the screen just cooperates right here, there we go. From roughly 2014, you notice that the funds are fairly high in their averages, and the average is roughly between 90 to 92% of average best fund in first and second quartile, meaning that you're always on top when it goes well. I'll give you a secret. Although our funds are amazing, for people to compete in a up market is very difficult. You got to just make sure that you got some of the lowest pricing. Your fund portfolio need to be good and well managed, but it plays around with the MER. The number of dollars that you pay for the fund. If we can reduce that, it goes back into your pockets. So that's where RBC has been very solid in the last couple of years. But when it goes wrong, and I'm pretty sure most of you can relate to that, in 2008, when we had the financial crisis, You can't chop up on the prices to recover the losses of the client. So you need somebody that's very strong at that point in time, and that's where the expertise of our managers at RBC paid up very well for our clients. If you notice here, at the worst of the crisis in 2008, 92% of our funds were first and second quartile. So we were up ahead, which allowed us to actually recover a lot faster and lose less clients. We had a very high retention rate, close to 96%. So it is basically that the people feel confident of the solution they have, and they will stay in there. So it's very important. Another aspect, well, if you see here, the graphic popped up right there, it's very convenient. It's just to say that RBC, in terms of management skills, and we'll take the Stanley Cup if you want. You know, I'm sure there's some hockey fans out there. But in terms of best manager or owner of the Stanley Cup, 11 out of 14 years we've been the best manager of, let's say, on the bond equity side, sorry. And 12 out of 14 years we've been the best bond manager in Canada. So that's a lot of Stanley Cups. So it means that it doesn't translate into a lot of losses to the client. It actually means that you have one of the best solutions in your portfolio. We're well equipped to handle this. Another interesting part is we'll take one example, and I'm pretty sure that Kris already spoke to you about maybe select portfolios. I'll take a fair chance at that one. Select portfolios are very popular with us, and they're built to protect you on the upside and the downside. They might look like one name, like a one-stop shop, but there's multiple funds in there, like almost 26 funds per type of select, and they will move automatically with our team. They can sway 10% more equity, 15% more bonds, depending on what happens in the market. So it allows us a way to wiggle a bit. Think about it when you're going on the road and it's a big pothole. If I allow you to sway 10%, you might avoid that, and that pothole would be losses to a portfolio. So the flexibility of these portfolios is amazing. And when I was talking, and actually Kris said we've been there for a long time. The portfolio I'm showing right here, the select balance, has been there since 1986. We've lived a lot of crises. You think about the energy crisis, like in 1987, the Gulf War, the tech bubbles, the dot-com, the World Trade Center. Anything that happens in there has been through these funds, and they still have an average of 6% rate return. So that's pretty good to have by all means. It's like 4.5 on 5 stars. It's really, really nice to have, and it will protect you. So you want to be on the top side, and even though everybody went down like we did, we will all follow the same trend. We're not out of the ordinary, but because we were a bit higher, you don't feel the loss as much as it should be, let's say as an example. And in terms of companies, well, RBC's been well positioned always in the top 3, which is something to be very happy about. And when you own it, just translates to more stability. And the last graph is those familiar with star ratings. I'm not talking about the hotels where it's a 4 and 5 star, although we all love those. It's the same thing for a fund, right? If you think a fund that's 1 star, it might not be as easy going as a 4 and 5 star, although past returns is never a guarantee of future performance. You can still look at the track record and say, well, no, that person's been there and they can handle it. And we're looking at 3 and 5 and 10 year, and there's a whole bunch of 4 and 5 funds in terms of start. So Kris can play along the portfolios knowing that there's a lot of stability. So I think we should add a couple of stars to that. And there you go, it feels better. So this is what I would say on the past part of RBC, on the strength and the solidity of the solutions that you guys are using. I don't know if it answers correctly the question, Kris.
Yeah, no, absolutely. And you guys have such an amazing track record, which is why we recommend you guys for so many of our clients. It really has been impressive and offered stability to our clientele, and something to just to elaborate, and you're going to elaborate on a little bit in a second, is they really get to take advantage of the expertise that you guys have that are monitoring the markets 24/7 and tinkering along the edges of rebalancing their portfolios as the markets update and evolve. And they really get to take advantage of that from the comfort of their own home while they're sitting on the couch watching, the hockey game. RBC is hard at work, rebalancing their portfolio and making sure that it's protected and producing. With all that said, in terms of, because the track record's all nice and dandy, but of course we live in a day where it's, what have you done for me lately? So what specific things is RBC doing right now to be protecting our clients?
All right, another good question, but I expected no less from you, Kris. So, what are we doing lately is, well, there's a lot of portfolio modifications that have been happening roughly since at least December, although they happen quite regularly. The most notable ones that we've been having is we had set a lot of cash aside in 2021. We had started trimming like on US equities and whatnot, knowing that it was going up, and there was a fair rally that was pretty impressive. So we started putting some money aside saying, you know what, there will be buying opportunities a bit later. Not knowing exactly when, but it's good to be on the safe side. So we did increase by about 0.5% our equity holding into most of our portfolios, which translates into, let's say, a higher portion into the equity market, which should benefit from the rising rates. And we didn't put them in any type of equity. At this point in time, the type of equity we want to look at is value portfolios or value equity, not growth equity or growth stocks. The growth stocks tend to perform better when you're decreasing in terms of prime rate and all of this, the government injection of capital and all of this, and technology, they do well. But when it goes up, it's not the type of equity that goes well. It's a bit like you look at the financials, the insurance shops, they will benefit from higher profit margin from some of their trading practices. So we've actually tactically moved and we're bumped up by 0.5 the holdings of equity. Now, I hear you in the background saying, guys, 0.5, that's like 0.5%, that's nothing. But bear in mind that most of our funds are $30 billion. So by moving 0.5, it is gigantic in terms of purchasing power into the market. And if we were to buy too much, it would actually affect negatively the price of certain stocks, that they'd be like, wow, we just sold everything. So by being big, we've got to be careful and very cautious when we make moves like that. But I can tell you that it's a nice switch. In terms of bonds, bonds are normally the counterweight that will stabilize the portfolio. They're still necessary, although we've had some issues lately saying, well, because when there are rising rates, bond will usually go, in terms of returns, will go down temporarily. Because the newer bonds are worth more in terms of resale value than the old ones. That could be maybe another training later on because it's a bit more complex, but know that we bought future bonds. We actually bought more bonds, so another 0.5% of bonds in there because the yields actually were, well, it was an opportunity of buying on the yield in the last couple of weeks. So we we actually added or injected cash into that portion, which should greatly stabilize the portfolio as well. So that's part for, I would say, the cash component that we did, the equity and the bonds, and the tactical move that we're moving towards more value funds than growth funds. That will be, I guess, that's the topic I could go about into that part. There's a lot still of buying opportunity. You do have cash on hand, so there's going to be continuous moves into the portfolios on a weekly or monthly basis for sure.
Absolutely, and very well said again. And to go from one tough question to the next, as you speak about retinkering and reallocating funds, obviously you're doing so with the expectation of what's coming in the future. And I think a lot of our viewers find it highly relative to them right now. What your thoughts are on what's coming in the future, and what sort of expectations do you guys have? Is it all doom and gloom, or are there positive outcomes coming? And what sort of things do you see for the remainder of just this year, and not 5-10 years down the road, but right now and in 12 months from now?
Okay. Although we don't have a crystal ball, if I had, I'd be probably vacationing a long time on an island. But we can fairly say with a safe bet that the economic outlook would be positive. So on RBC's side, our analyst, our economic, chief economic officer said that we're still looking at a positive global GDP around 3.7%. For this year and the next, which means that it would be positive type of growth. We know that on the Biden side in the U.S., there's a lot of cash money that is being put. There's special plans, they've modified it a bit since the first electoral promises, but there's a lot of money that's been approved by Congress to invest into the American economy. This should still spill over in the global and on the Canadian side, even though the Buy American kind of way. We're still a good economic partner, so it's positive for us. If you look at the, as an example, if you've got a good balanced type of U.S. equity basket, let's say you've got like for a bit of everything there, but well managed. We still expect between 8, maybe 10-ish%, not in the 20 or 30 things I'm good at, but we're still seeing some positive, like I would say in the 8%, but you can never guarantee a rate of return because there's so many things that are, codependent that can happen. Anything can happen and it could end up being a -10. But I know that the forecast is, in the positive. It's not going to be double digits. It's going to be in the single digits, but it will recover. Inflation's been a big fear. I know that people have been looking at that, but in spite of inflation, I mean, the fourth quarter of Canada, I think the GDP was at 6.9%. So the banks, like Bank of Canada and the Fed, have justified increasing their rates by 0.25, and we probably will see a next one fairly soon because there's no job loss. The unemployment is very low. There are rate hikes, salary hikes. The inflation we're living is just for a lack of distribution. Everything is stuck overseas or in containers, and difficulty of creating everything in terms of the products we consume. We do expect that it should stabilize within the mid 2022. So it's going to start to go down. It's going to start to stabilize. So inflation should be on a downward trend. It probably will take a year or two to recover to previous levels in the 2.5% to 3% ish. But we're still seeing that very positive. It's not negative at all, and we're thinking better. How do we say? Better skies ahead.
And I'm sure that's a huge relief for our viewers. Of course, you don't have a crystal ball. I don't have a crystal ball. Nothing is set in stone. But just to hear words, because there's a lot of fear going on, a lot of clickbait articles, a lot of whatnot, and just to hear that that there is light at the end of the tunnel, and in the short term as well, right? Things are stabilizing. Obviously, in the last 2 years has been kind of an anomaly with COVID in terms of the market production, and things will stabilize, and so in terms of future expectations and whatnot, does that make right now a good buying opportunity, being that you're seeing a positive return by the end of the year?
Certainly. I mean, our managers saw good purchasing opportunities when the markets dropped. So it's the same for the viewers. It's just on a greater scale. If you see something that you like and you're going to buy because it's like something that is very strong and it's a product that you appreciate, and it's down by 10 or 20%, it's just an opportunity to buy in, knowing it will go back up. But the reasoning sometimes on the client end, when I used to work in an institution, people would say, but my funds and the bank, let's say they're not held with you, they're at RBC, TD, and index. My funds went down. Is it a good time to move? Because I'm going to take those losses. It's true that you can do it that way, but you got to do it the other way. We went down as well. And the way we went down right now, our guarantees are about roughly back to October 2021. So it's still in the high peaks. You're still securing your assets. We haven't dropped that much considering the rally of the last 5 years. So they went down, we went down. So you take a quick loss on that one, but you're buying on a discount on our end, and then we go back up. There's essentially no losses. There are going to be two impacts to that trade, however. If it's non-registered money, I mean cash, anything outside of RSP and TFSA, it might create a loss. It could, if it's possible, if you bought recently. If there's a loss, well, you can reuse that loss against capital gains from past year, or file it up for future years. So there's a taxable consequence to that, which could be positive, because a loss doesn't mean it's a loss. It's applying against a gain, which cancel each other. So that's something that Kris can look at with you guys. I know you've got a good taxation expertise on that. So, and the other part is it might actually reduce your MER, because when we look at most of the similar offer out there, whether it's institutionally held in a bank or a mutual fund, we're actually most of the time cheaper in terms of pricing than the other institution. So you'll benefit from the lower price right away. And when the rally picks up, well, you just bought into a nice solution that has guarantees, but you're going to have some nice returns from what we've shown you in the past, saying that we can behave well. We can't guarantee how it's going to go, but we certainly have some expertise out of that. So yes, sure. Long answer for yes, Kris. It's a great time to buy.
Absolutely. Well, I appreciate you saying it that way and highlighting some of those points because I know a lot of the conversations I've had in regards to those thinking of transferring over to us, because we do offer insured protected investments. A lot of people, especially the mutual fund side or stock side, are looking to put some added protection on their investments, but are somewhat hesitant because they want to wait for their portfolios to recover prior to transferring over. But as I explained to them that, and as you just did, because everyone's familiar with the term, buy low, sell high, right? But it's not as if, or some cases anyway, as if you're moving from one individual stock that's underperforming and transferring over into a stock that's overperforming or at its high, right? The major majority of the market right now is at that low. So yes, you're maybe selling low, but you're also buying low as well. So when the markets recover, or where you currently are waiting to recover, your new portfolio would be recovering all the same as well too, right? So it's a great balance. It's a great opportunity to be moving into a secured investment and catching that momentum recovery ride on the way there. Absolutely.
Very well said. Yep.
And so I believe the last question I have for you is some of the conversations that I've been having with clients of late as well, as we're always trying to adapt and do the best we can as things progress, is particularly those who have RRIFs or scheduled withdrawal plans that are regularly withdrawing each month. We have had some conversations to simply delay those RRIF payments to the end of the year, maybe sometime in November and December, as opposed to regularly withdrawing each month for right now, just to simply give their portfolios a bit of time to breathe and recover. Now, of course, this isn't a solution for everybody, as some people are budgeted and need those monthly income. But for those that can, is that something that you guys are suggesting, that if you can simply delay withdrawing to sort of push it to the end of the year, as opposed to regularly withdrawing for this period?
I mean, yes, that's a great strategy, and I would fully suggest it depending on the timing, because you're not constrained into making a withdrawal during a specific part of the year when you own a RRIF or a LIP. And when you're in payout mode, it's really up to you during the year to actually start withdrawing. But it could be pushed over till the end of the year. And it would, like Kris said, allow the units to actually time to recover from a loss at that point in time. So if you don't need it, it's not in your budget, and you don't depend on it at this point, consider just asking Kris's team to make a quick switch and push it further down. Another thing that we can look at as well is minimums and maximums. We notice that a lot of clients will have sometimes a higher payment than the minimum RRIF or the minimum LIP itself. So what's going to happen is you could actually drop it. If you're at the highest, you can drop it temporarily to the minimum fare available that we need to give you, that the government kind of forces everybody to get. And then you can readjust it as of next year in January, maybe bump it back up to what it was, depending on the strength of the economy. The deal is just not to withdraw when units have taken a hit. And if you have funds that you can review, and that's for you guys as well in the team, is if you have multiple funds, you can have a look at maybe changing the withdrawal of the RRIF payment to another fund that probably was less impacted, let's say. So if you got like a bond fund or something that was more conservative in nature and it didn't go as down, let's say way down, you could change the source of payment from that fund to alleviate the stress on the portfolio, allowing it some time to recover.
Absolutely. At the end of the day, it's all to be interpreted on a case-by-case basis, right? Everybody's stories and situations are slightly different. And so I just welcome any viewers that are interested in learning more on that topic. Please don't hesitate to contact me or speaking with your own advisor. Of course, if you're a client of mine and if that's something of interest, please don't hesitate to contact me if we want to talk further and see if that strategy could help or a different strategy. We are always there to help. So I think in terms of this video, I think that about wraps it up for us. I think we covered some great topics, things that are highly relative to our clients, and I hope they find it informative and helpful. And I really want to thank Real for joining me and going through everything today. Any final thoughts or wisdom you want to pass on to our viewers?
Well, I mean, we've spoken a lot, but all I can say is that, you know what, it's springtime. It's not just for us to be happy, but the portfolio will start to do and bloom back again, let's say. So let's just focus on the good things that are coming up with everything that's happening in the COVID slowly going there. Take the time to not just focus on the portfolio, go see your family, go see your friends, and let's live outside our bubble at this point, and then we'll go back to a portfolio, hopefully, that should have recovered. So just focus on life at this point. And Kris, it's been amazing to be with you guys again. Looking forward to the next interview.
Absolutely. Me the same as well. And yeah, really thank you for joining me and sharing your expertise. You're a terrific resource for us here at Bowie Financial. And we look forward to continue working together for a long time and to the benefit of our clients and doing the best we can all together. So with that, I'll say goodbye. And of course, again, one last time, any questions, please don't hesitate to contact me or any other advisor here at Bowie Financial. We are here to help, whether you're a client of ours or not. We're here to have open discussion and simply talk about ideas that could potentially help you and your family and simply do the best we can. So I'll end the video there and bid everyone farewell. Take care.